Thank you, Mike. We started talking about this topic a couple of months ago and putting this together really based on our conversations with our clients. In our past conversations, we talked about many things along the lines of COVID restrictions and what they're experiencing with those challenges, and it kind of morphed into new challenges being experienced today. How to grow sales and margin kind of turned into how do I service my current customers with supply chain disruption, cost increases, and labor constraints. Whether you believe these issues are short-term or long-term, it is important to have a plan to be able to react when that time comes. So we're going to start off today with a presentation by David Presson with First Bank to talk about the current situation, the current historic trends and current trends in the economy. Thank you, David.
All right, thanks, Tim. And if we could bring up the slideshow.
Sorry about that, just 1 second. All right, David, and you should be able to see that now, yeah?
No, Mike, sorry, I don't see, I just see myself.
Okay, sorry, 1 second here, and...
Here we go, I see it now.
Okay, perfect,
Right.
There we go. You're good to
All
go.
right, thanks, Mike. Yeah, so for my part of today's program, I'm going to borrow a little bit from the famous Charles Dickens Christmas Carol story and call my part Inflation, Past, Present, and Future. I'll include some historical perspective along with some of the factors driving inflation today. Then I'll jump into future expectations for inflation and how to best structure your investments against it. So as shown by this slide here, this goes back to the 1950s. Showing the yearly inflation numbers, or CPI, which is the official government inflation number. Notice that other than the high inflation of the 1970s and early 80s, inflation for the most part has been fairly low. The average over time has been 3.4% annually, though the number is somewhat inflated, if you can pardon the pun, by the high numbers in the 70s and 80s. Most recently, since the great financial crisis of 2008-2009, inflation has been pretty low. In fact, in some years, we've even had deflation. But as shown by the spike on the far right-hand side of the slide, the latest government number shows inflation running at an annual rate now of 5.4%, the highest number since the late 1980s. We could go to the next slide. All right, Mike, you can go to the next slide. So what happened? So what's causing the recent spike in inflation? Are these factors temporary in nature or more long-lasting? The Fed believes they're temporary, but let's go over some of the factors driving the recent spike. First, we've had the COVID-related supply chain disruptions. Then we've had a huge amount of government stimulus, so lots of money sloshing around that needs to be spent somewhere. We've got commodity prices going up, and then labor shortages, which are leading to wage pressures. Basically, at the heart of the recent price increases is basic supply-demand imbalances. Some of these factors could prove to be temporary, as the Fed expects, but others could be more long-lasting, especially wage pressures. But let's look at one recent example, the market for used cars. Last month, the price of used cars rose 0.2% after having risen at least 7% each of the last 3 months. This category, along with hotel rooms and airfare, has been one of the primary drivers for inflation in recent months, in fact, accounting for roughly half of the price increases. So this is a good example where demand increased, yet supply was still somewhat constrained. For cars, there was a temporary slowdown in production due to the pandemic and a shortage of computer chips from Asia, which also constrained supply, which at the same time demand was increasing as people were eager to get out and travel again. Now let's look at several recent examples of rising prices. Mike, if you could go to the next slide. First, we'll look at commodities. This shows the Bloomberg Commodity Index, which is a broad gauge of many different commodity prices and is now at its highest level in 6 years. For example, just in the last year, natural gas is up 118%, coffee up 79%, corn up 69%, sugar up 52%, cotton up 48%, and wheat up 35%. If we go to the next slide, we'll look at gasoline prices. The national average today is about $3.20 at the pump. Last year around this time, it was only $2.20. In fact, in May of this year, we passed $3 per gallon for the first time since 2014. Go to the next slide. One important trend to watch for a clue for future inflation are wages. Many companies have struggled to keep up with increased demand for their goods and services. Even as unemployment has fallen from its pandemic peak of 14.8% to around 6% currently, the number of job openings in the past year has grown by nearly 70% to approximately 9.2 million unfilled positions today, the highest level in 20 years. In a recent survey by the NFIB, 49% of small business owners are reporting job openings they can't fill. And just a recent example here in this area, many restaurants aren't open for lunch because they can't get enough help. In addition, the rates of voluntary turnover are also at their highest level in 2 decades, leading to pressure to fill new positions. Thus, companies have to pay up either to attract new employees or keep current ones. As a result, over the past 4 quarters, the U.S. has generated more wage inflation than at any point over the last 40 years. And wages are growing now at 4% annually, above its long-term trend line. And if we could go to the next slide, Mike. So one final bit of bad inflationary related news. I hate to break this to everyone, but if you going to your local Starbucks, you might be expected to pay higher prices for your cup of coffee, though prices have backed off a little bit recently. So now let's turn to inflation future. If we could go to the next slide, Mike. So let's look at what the markets are pricing in right now, looking at future inflation expectations. This is one of my favorite numbers to judge future inflation expectations, and it takes into account the wisdom of hundreds of thousands of investors around the world. This shows what the market is pricing in now for the next 10 years. If we look at the yield on 10-year tips versus 10-year treasuries, this gives us the neutral point or break-even point of what investors demand of their bonds to be protected against inflation. In other words, it wouldn't matter if you buy a 10-year treasury or a 10-year tip, your expected return would be the same. So the bottom line here is that the market doesn't seem overly concerned with inflation right now. After hitting a low in March of 2020 of 0.5% and then hitting a high in the spring of 2.5%, we're now at around 2.35% currently. So while this is below the long-term average of 3.4%, but it's still higher than the recent trend since the great financial crisis, and is also higher than what the Fed targets right now of 2%. So if we go to my next slide, Mike. So if inflation is going to be a concern going forward, to expect somewhat higher inflation, what are some of the best ways you can do to protect your current investments? Well, the best hedge and the one with the highest correlation are TIPS, Treasury Inflation Protected Securities. These move lockstep with inflation. For example, next year, if inflation goes up by 5%, the value of these bonds go up by 5%, as well as the coupon. Another good hedge historically has been real estate, as real estate has rents that go up and market prices that generally can track inflation. Gold has been a decent hedge over time against inflation, but not always. There have been some long periods of time of higher inflation, yet gold did not fare so well. So be careful of just using gold as your only inflation hedge. And finally, one of the best long-term hedges against inflation has been stocks. Stocks generally go up as companies can increase their prices over time, leading to higher stock levels. But what has been the worst inflation hedge? Well, what people perceive as a safe money market. Just parking your money right now in a money market that's yielding close to zero, with inflation running over 5%, you actually would be losing money then after you factor into inflation. So with that, Tim, I'll turn it back to you.
Okay. Thank you, David. And I think that really sets the table well. Mike, I'm going to turn it back to Mike, and Mike's going to ask some polling questions for our audience. So Mike?
Very good. Thanks, Tim. So yeah, grab your mouse. And we have a few quick questions here, quick yes, no questions. I won't leave them up very long. I'm going to start here with the first one. And this first question says, has your company experienced price increases from vendors or suppliers? And again, if you're one of the First Bank staff here, maybe you could answer this on behalf of some of your clients. Do you know if they have experienced price increases from vendors or suppliers? All right. Go ahead and make your selection just a yes or a no. Okay, let me give you another 10 seconds or so. Again, has your company experienced price increases from vendors and suppliers? And I'll close this one down in about 5 seconds. 2, 1. All right, so let me go ahead and close that. And wow, 97% of you said yes. So right off the bat, clearly there's an impact there. Let me go ahead and jump to the second question. And let me launch that one now. And it says, has your company experienced supply chain disruption or production allocations? So again, for our First Bank family that's on here as well, maybe you can answer this question on behalf of your clients that you know the answer to, and that will help us in this information as well. So I'll leave that open another 15 seconds or so. Again, the question is, has your company experienced supply chain disruption or production allocations? And the votes are rolling in. Okay, we'll go another 5 seconds here with this one. 4, 3, 2, 1. All right, and it kind of teetered there a little bit, but actually did fall at the same level as before. 97% are saying yes, that they're seeing that as well. All right, let me go ahead and jump to our third question and click the launch button here. And this one says, has your company experienced workforce challenges in retaining or recruiting talent? So again, to you or companies that you know of firsthand, are they experiencing workforce challenges in retaining or recruiting talent? And we'll let this one go another 10 seconds or so. Okay, and not quite so lopsided this time as I'm seeing these numbers in real time. We'll give another 5 seconds or so here. All right, so yeah, so this one's much closer. So 89% are saying yes, but 11% are saying no. Still, the vast majority are clearly being impacted in this way as well. So let me go ahead and close that down. And we'll launch the fourth and final poll now. And that poll says, has your company increased wages to recruit or retain talent? So has you or a company that you have firsthand knowledge of, have they increased wages to try to recruit or retain that talent? And we'll let this go about 10 seconds or so here. All right. Another 5 seconds or so for this one. I'm still seeing some fluctuation in these answers. And I'll go ahead and close it down here in 4, 3, 2, 1. Okay, so this one was definitely split a little bit more too. 76% are saying yes, 24% are saying no. So with that said, Tim, what do you think of all
that? Not totally unexpected, pretty high numbers, but clearly these are the same things we're hearing from all of our clients and we're talking to them. So it kind of sets the table very well. We know we have these issues and challenges to deal with. What do we do about it? And for that, we're very pleased to have Jack and Trish from Collaborative Strategies here, who consult with hundreds of companies here in St. Louis on issues, on these very types of issues. So I'll turn it over to Jack and Trish.
Great. Thank you, Tim. Thank you. We're pleased to be here today. A topic that is certainly high on those high percentages of people that have talked about them. I think we have 89%, 97%. So they truly are the issues of the day. Just real quickly, Collaborative Strategies, we're a management consulting firm. Our expertise is in strategic planning, but we're also kind of a one-stop shop for our clients, doing executive coaching, search, and board development. And been around since 1984, proudly located, headquartered here in St. Louis. If you want to go to that first slide there, Mike, that'd be great. 17 of us professionals, mostly Midwest. We branch out a little further, mostly Midwest. But I think what hopefully we can help contribute today, it really comes from I'll say the privilege and the active access to over 300 businesses each month. We get very close. We're very intimate with our clients. We're on the front line with them, and we do have a privilege to work with some very well-run businesses. And so we've learned a thing or two here in this different environment that we've been working in. I will say this though, that those high percentages don't surprise us, because Tricia, I'm just thinking of all the strategic planning sessions we've been in, 30, 40, 50. It's the topic, and I'll say two things. One is everybody shares the issues with supply chain and labor, but also very interesting is I've never seen so many companies being so successful. Profits are high. Unless you're in maybe the event or the hospitality business, across the board. I mean, professional services, manufacturing. It's really an interesting time. So people are very frustrated. Okay, but at the same time, people are having really great years. So that's a unique thing that personally I've never seen before. So let us share with you some of the things that we're seeing. But I think what most people are interested in, as Tim said, is like, what are you doing about it, right? What can you do about it? And so we'll talk about supply chains, and then we'll get into people. And then we'll end a little bit with our view on inflation. So go ahead, Tricia.
Yeah, absolutely. So, and also just to quickly kind of off of what Jack was saying, what we're seeing with our clients, I think one of the reasons that we're seeing, some surprisingly exceptional performance is because we really saw our management and leadership teams, kind of use this as an opportunity to up their game. And so it's been really incredible to be a part of that and to see that happening. And I think it's exciting for a number of reasons across the board. So let's just jump into supply chains, and as it says up top, most everything is in short supply. We're seeing, as you can see, all kinds of things here: longer lead time, higher prices, inability to get actual inventory or stock shortages. And a lot of this is due to container disruption. And there are a number of factors that pull us into the place where we're at relative to shipping containers. There's the Suez Canal blockage. It was not COVID related, but just incredibly poorly timed. 3 major Chinese port shutdowns in May, June, and August. And then we're actually still recovering from a significant uptick in blank sailings that we saw at the beginning of the pandemic, which was just empty shipping containers moving around the globe. And so there's kind of a general consensus that there's more than enough boxes. They're just stuck in the wrong place. And so we're seeing shipping times that used to be 30 days from Beijing to Chicago. We're seeing with our clients around 70, in some cases 90 days to get things to the Midwest. We're also seeing some suppliers refusing to send shipping containers inland because they're trying to get them back to Asia as quickly as possible. And so we'll kind of go into some of the different things that we can see about that, some different things that we're seeing our clients have success with on that. So we can kind of jump into the next slide there. So some key moves: get serious about lean. This is kind of ties into what I said earlier, where we're really seeing some of our clients up their management and leadership game. And really, the saying goes, never let a good crisis go to waste. And we're seeing our clients really better understand their business and what it takes to run it, and then intentionally and purposefully building what it takes to run and nothing more, which actually helps with retention because everybody's got a job and everybody's gainfully and actively engaged, which Jack will get into in a minute here. Cut back on variety, so reduce that complexity. Whenever we're thinking about inventory turns and stock shortages, the most we can reduce the complexity and the number of items needed to get something out the door to deliver to clients, the better. Diversify your supply chain. So, we mentioned the shipping container issues, the supply shutdowns in China. Our clients who have diversification, whether that's in Asia, in Vietnam, Indonesia, other places where we're seeing growth, giving them those options to be able to shift their manufacturing or distribution sources outside of where there may be more significant constraints than what you're seeing elsewhere. We also had a client who had some real estate. They're headquartered here in the Midwest and do a lot of their work here. They're actually in Missouri, but they had some real estate out in Las Vegas. And so they were able to really quickly turn that into a warehouse where they were able to receive their shipping containers from Asia and then transfer them over to traditional over-the-road trucking, which made all the difference for their ability to be able to react and ensure they can still get product to their customers in as timely a manner as possible. I think that's all I'll touch on for there and pass it over to you, Jack, for labor.
Thank you. So if you think the supply chain's tough, right? let's talk about people for a minute. Once again, this is something that is being felt everywhere across our country. David earlier talked about, you'll see my first bullet point up there is that that there's 8 million, and David's got a more current number, 9.3 or $4 million unfilled jobs. We think that's a low number. We think there are many more than that unfilled jobs. Just in our small world, we can identify at least 5,000 openings. There's a little collaborative strategy. So it's a very serious issue. I read an article last weekend. It's titled "The Great Resignation," and it just talks about how people are leaving the workforce in droves. In fact, the U.S. age, the people of working age in our country has stopped growing and is actually declining. Okay, so you've got this shrinkage of the workforce. Okay, in the face of the increase in demand that we've been talking about. So think about that for a second. Okay, that's a lot of pressure, but here's the other side. With the internet, okay, and online recruiting, all right, it has intensified with that great demand out there. Anybody can go home. They have a bad day at work. They can just look on Indeed, okay, and they can find a job. And sometimes we're not even looking. There are people talking to them about wanting to come to work. So you have a shrinkage on one side, and you have people just being aggressively courted on the other. If you're more of a frontline employee, you're maybe making up to like $50,000. It's Indeed, okay. Some of those numbers you see up there, I mean, it's crazy. Was it hundreds of millions of people visiting this website? And then if you're more in the professional ranks, LinkedIn, which is, and I know you all are familiar with that. But think about that. You can get to anybody now. You can get an email to anybody you want that's registered on LinkedIn, and just the number of openings out there. So that combination of things, you hear the term talent war a lot, but it really is. It's an all hands on deck kind of issue, and we've never seen it like this. And it's how you're going to win today. If you can win this, at recruiting and retention in this environment, I mean, you're golden. So let's go to some thoughts about what you can do. Maybe the next slide, Mike. All right, so we're in these strategic planning sessions, and it's all about people, not having enough people. there's tens of millions of dollars of equipment sitting out there, and they can't start a second shift because they can't get the people to do it. So every time we go, we dig deep. Our client, and this is like every time, our clients will go, we probably could do a little more on retention. People are, we're not used to having to work so hard to retain our people. And so it's the first place you need to go is really think about what are you doing for retention. And we're telling our clients, hey, every time you look at an employee, realize that they are being asked to leave your company for more money multiple times a year. Everybody. They're being asked to leave your company for more money. So you need to have the some of these keys here. What do we all know? Why do people leave their jobs most of the time? The relationship with their boss, right? I mean, that's a very important thing. We need to look at the training of our supervisors. We need to understand the relationships that are going on, stay close to them, and make sure that we're not creating unnecessary turnover. Purpose. I don't know, Tricia, what is I can't remember the percentage of millennials in the workforce now. It's over 50%, right? Is that right?
Definitely over 50%. Yeah, I can't remember the exact percentage.
Yeah, so it's the dominant. And as we all know here also, they're more about bringing home the bacon, okay? They want to be a part of something that's bigger than themselves, that's meaningful, that has a purpose, that helps to make lives better. Tie into that, you need a purpose now as an employer to retain your people. Compensation, man, the minimum wage is like what, $8? Okay, forget about that. The minimum wage today is $15. That's just the minimum, okay? And if you want to move the needle, if you want to get people to answer your ads, we're finding it's probably $19 or $20. That's the kind of minimums you're talking about out there. And you got to stay ahead, and you can't, you got to worry, right? Because if you raise the minimum, now you've got the other parts of your company. You got the compression. So we're very bullish on staying ahead. We're in an inflationary environment. Don't lose people because of compensation. You can pass it along in price increases. We'll talk about that later. Price increases are going through, like we had just 2 weeks ago with a client, 80 extrusion steel customers, big customers, 10% price increase. One customer fought it. Our clients said, "Hey, we appreciate that, but if you can't do it, we understand. But we're gonna have to kind of gradually have to ease you out. We can't supply for you anymore." Customers, "Oh no, take the 10%." So we've never seen that before. Okay, and then lastly on retention, to talk about career paths, right? People have something to look forward to, something that you're working with them on. Let's go to the next one, Mike, please. All right, recruiting. This is a whole new game. All right. There's opportunity because a lot of companies are not, they are slow to change their compensation plans. So, in this period of people not going to the office every day, we're noticing that it's easier to get people to consider a change. So, this is a good time to recruit, actually. We kind of find that, right, I never thought I'd see this, but recruiting is probably more important than sales. Selling's easy. There's plenty of demand out there. Recruiting is hard. It's not HR's job. Don't fall in that trap. Well, HR couldn't get us any people. HR can help support, okay, but it's the people leading the people. Your sales managers, your operations managers, your general managers, they have to get out. They have to be primarily responsible for recruiting and retaining the people, and because it's got to be under their control. It's a unique skill of recruiting today. All right, we found that that the companies who are winning the recruiting battle, almost all the time they have 1, 2, 3 people maybe who are very good on the phone, very good at getting in people's heads, kind of finding dissatisfaction, connecting the benefits of a company with what their dissatisfaction is, and really selling people on coming aboard. And it's a relationship to relationship. People, the first thing we walk in, people have a recruiting problem, they go, "Oh, we got to go social media." And we go, "Yeah, okay, that's important, okay, but that doesn't get people to change their mind. Anybody who's been looking for a job has found one, okay? You got to talk people out of their jobs. And that's why these employee referral programs are really important. If your employees like working with you, they can represent you, but it's person to person. That's the way you got to get people to move today. So you can see it's a much different game, but it can be done. And this is an interesting time to strengthen your teams. All right. Back to you, Tricia.
Thanks, Jack. And just really quick, another kind of thing that we're seeing with some of our clients that is new in the recruiting game and really retention game is that a lot of particularly tech talent or talent that is, very easy to kind of fall into that work from anywhere type of profile is being recruited away by the coasts. They're actively and aggressively seeking Midwest talent that they can get at Midwest prices, and not moving them. And so that's just something that's adding to that incredible pressure. Like Jack said, that you know that your talent is being recruited every day, which all of this ties really well together, right? They're all connected. Inflation. Transitory or structural. At Collaborative Strategies, we say structural. Higher wages are here to stay. Larry Fink, the CEO of BlackRock, came out maybe a few weeks ago and director level and below raised every salary 8%, because he said this isn't going anywhere. This is more of a market correction than a blip. And so really needing to understand kind of how to react in that way that at least from our perspective, and quite a few others, this is here to stay. We need to make changes that reflect that. So a lot of prices that went up are not going to come back down, except maybe for office rent, which ties into that work from anywhere concept, which is really critical to recruiting and retaining your top talent. Let's see, we can go on to the next slide there, Mike. So some key moves. Inflation can be your friend if you stay in front of it. Jack talked about some of our clients who are taking this opportunity to make some significant price increases and are gaining margin from, pre-pandemic and really contributing to some of their success. Another thing to both watch out for and also consider is something that's called shrinkflation. It's also known as product downsizing. And so that's, your cereal box is likely a little bit over an ounce smaller than it was a year or two ago. Charmin actually made your toilet paper sheets shorter. So it's still 650 sheets, but it's shorter. And so that's kind of affectionately called shrinkflation, so lots of different ways to approach it, whether changing your product, which increases your margin, while keeping your price the same, or just straight up increasing your prices while keeping your product the same, and or even rethinking what you're delivering.
Great. Thanks, Tricia.
Yeah, back to you, Jack.
Good, thank you. So those are some thoughts for consideration, and we'll end with this piece here that unfortunately there is no crystal ball, and those who try to guess too much, right, can end up in not such a situation. But I guess we'll end before we go back to Tim and Mike with it's important to have a split screen during this time, right? Look at the short term. A lot of these things were short term, but obviously you got to keep the longer term in mind too. We're all in this game for the long term. Thank you.
Okay, thank you very much, Trish and Jack. And I'll remind everybody, type in questions if they have questions for our presenters today. Let me start off with this. And for Jack and Trish, you touched on it briefly, but when you're working with your clients on strategy, we're coming from an environment that generally we talk about sales, mm-hmm. and how to create sales. And now we're in a point where really it needs to be about margin and maybe paring back customers and looking at processes that you have to determine who are your most profitable clients and at what margins. So can you talk a little bit about what strategies are there in creating those processes at companies?
Good. Yeah. Well, it's very interesting, Tim. We find in the beginning that most companies don't really have a good idea of what their profitability per customer is. They think they know, but they don't. And as Trish was saying, and people upping their game now, we're spending a lot of time on profitability per customer, and also just on our cost to serve, our cost to serve customers. So when you get good at it, it changes. I think. What do you think, Tricia? 30% of your perception?
Easily. And
Yeah.
I think looking at both the client profitability, but also the product or SKU rationalization, which is part of that reducing complexity and also, enabling you to really understand what's profitable within your product mix. We've seen a significant amount of progress in that area. And these are things that, these aren't new things. We've all heard about them, been talking about them, things that we all should be doing for years and years, decades. But the situation has really kind of brought it to a head. We're seeing our clients really put a lot of focus and plans around how to actually move forward, stop talking about it, start doing it, and really seeing some positive results.
Okay, thank you. And maybe David, there's been a lot of in the media recently about the Fed's reaction and what they're doing. Could you spend a couple of minutes and go through, kind of explain in layman's terms their strategy on asset purchases and what their recent announcement about tapering will mean for the economy and for our clients?
Sure. So what the Fed wants to do, they want to make sure that this fairly fragile economic recovery is sustained, that they don't choke it off. But one way they're trying to do that is to keep interest rates low, have the cost of capital cheap for corporations where they can go out and borrow money. You can get a mortgage, buy a house without paying as much in interest. So the way they do that is they go out and buy bonds. That's the asset purchases that you're referring to. They go out and buy bonds. And when you buy an asset, that drives up the prices. And with bonds, if prices go up, yields go down. So that's one way the Fed is keeping yields low, is by buying bonds. And when they're talking about tapering, what that means is they're going to start to taper their buying. So they're not going to start selling bonds. They're not going to stop completely from buying, but they're just not going to buy as much. And they're trying to signal that as far in advance as possible, as the markets generally don't like surprises. So the Fed is trying to be very transparent to signal this is coming down the road so the markets can start to adjust.
Okay, thank you, David. So for Jack and Trish, how fast are you seeing entry-level wages increasing this year?
Go ahead, Tricia.
I was going to say, Jack has a lot more experience to talk about, like comparatively. But it's just, overnight. Going companies who thought they could get by at $12 or $13 an hour, quickly realizing that they couldn't, and going up to that 15 at the bare minimum. But as Jack said, really 19 or 20 if you want to be pulling anybody in.
Yeah, Tim, I think that we talked about with Indeed and the electronic marketplace, right? It's just in everybody's face, and so you really need to have an idea of what is being paid around you, I'm not sure it's done yet, Tim. I think it's still going up.
And I think as the reality hits with the aggressive recruiting that we're seeing from the coast that I spoke about with that top talent, I don't think we're anywhere near being done, particularly here in the Midwest.
Okay, thank you. Here's a question. It seems as though employees today have the most leverage where employers had it in the past. Do you see this changing? And then maybe add and you touched a little bit too, but on that same topic, it's what we've gone through with COVID and people like working from home. That's just another added issue that employers are having to deal with. So in terms of the leverages,
no, right. The tables really have turned. And I'm not. I don't know if that's good or bad. It's just different. And we find that a lot of our owners and CEOs, they would like to have everybody back in the office, but they're afraid to do it because they're afraid they're going to lose their people. So it's we've been coaching our CEOs to not make any long-term commitments or decisions. Take it 6 months at a time, because I think the whole world's kind of just figuring out what this work from home means. And yeah, you want to be just like the Fed. You don't want any surprises. You want to just give people 6 months at a time. Here's what we're going to do, and we're going to work with you.
And I think giving people that advanced notice, though, there's so much anxiety and unknown in our world that where we're seeing, actually, we've seen gains in employee engagement with our companies who handle this really well. Our companies who aren't necessarily handling it as well and are seeing some hits in their employee engagement, they're like, well, it's a pandemic, but the companies that are knocking it out of the park are seeing gains in their employee engagement from pre-pandemic. And it's because their employees appreciate the thoughtful care that they're putting into how they are treated, how they work, what the expectations are. And so I think ensuring that you have a plan and that it's well communicated in advance so that people have that kind of comfort and confidence of like what's coming is really critical.
That's great advice. I don't see any questions in the any more questions in the box. Do you see any, Mike?
Yes, there is. No, I believe that's actually no. One just came in here from someone. It says, "I see this round of inflation driven more by the supply side of the equation. Will inflation moderate as the inventories catch up with demand?"
David, you want to take a shot at that?
Well, it depends. I mean, it's the whole supply and demand imbalance. If it's perfectly in balance, yeah, it's not going to cause a price increase. But if supply can't keep up with demand, but also you have to think about this. There's just a huge amount of money out there right now to be spent. I read recently somewhere that there's close to $5 trillion left to be spent, and if that was to be spent gradually over the next 3 years, it would increase consumer spending by 5%. So are companies prepared for that type of demand? Do they have the supply to keep up with it?
Okay, great.
Very good. Thank you for that.
Yeah. If that's it, I think that's our last question. So first of all, I want to thank David, Jack, and Trish for really great presentation and good things to think about going forward. And I think as we try to advise our clients, it is good to plan. It maybe now is not time to put that plan in place, but now's not the time. It's the time to plan for those changes. So that's something ready to put in place when that time comes for your clients or for your company.
Well, and I think just to kind of go off of that, Tim, what we saw with our clients, a year and a half ago, was those clients who had those longer term plans or those North Stars were able to make better, quicker decisions when they were faced with uncertainty. And so having that long-term or longer term, which in today's world is 3 to 5 years, right? That's pretty long. But kind of knowing where you're going, enables you to shift left and right within how you're going to get there, but really helps our clients make a lot stronger decisions. I think we have seen over the last few months, a pretty significant uptick in our business as companies begin to realize, like, hey, I would have been better off last summer had I had that plan. And I want to make sure that I have that plan now and am working on it, and that there's that flexibility in that planning framework for uncertainty so that I can make decisions to go left or go right, but I know where I want to go.
Right. And I think we saw that in the last recession, that those that waited a little bit too long took a little bit longer to come out of the impact of that recession. So
yeah.
With that, I'll turn it back to Mike for sign off.
Yeah, thank you so much, everyone, for all of your time and expertise today. For all of our audience members here, please take just a couple of moments to fill out a brief survey that's going to pop up after you leave our session today. It will help us improve our service to you. With that said, have a great day, everyone. We'll catch you next time.
And one more thing, we will post this on our website later today or tomorrow, so people can view the slides and the presentation.
Absolutely. Have a great day, everyone.
Thank you.
Thanks so much, all.